We've got a special guest today. I want to end with one of the biggest players in the ETF universe out there. Vanguard currently oversees more than $1 trillion in exchange-traded fund. That's T, not a B, T. Joining us now, the man who runs it all, Rich Powers. He's the head of ETF product management over at Vanguard. $1 trillion. I know that's, daily work for you guys over there at Vanguard. That's not a bad number here. ETFs are 20% of your assets right now.
They are, but they're about 35% of our cash flows over the last 3 years. We've seen more and more investors, be it financial institutions, advisors, and increasingly the individual investor embracing ETFs as a way to build a diversified portfolio.
So what areas are you seeing growth? Where's the money coming in this year? We've been hearing about bond fund inflows. I'm so tired of that story. I'd scratch my head. But what else are you seeing inflows in? Where are your people putting money?
Yeah, I mean, the most popular ETF in the industry right now is the Vanguard S&P 500 ETF, VU. It's about $10 billion in cash flows year to date. Also in our total market fund, be it the equity side of things or our total bond market. And then interestingly, total international bond ETF, BNDX, is a product where more and more investors are
so these are all the biggest index products that are out there. And I want to point out, the total stock market is essentially the entire, is it fair to say it's the S&P 1500? I know it's not indexed to that exactly, but it's essentially the U.S. stock market.
Total
right?
U.S. stock market from the largest companies down to the smallest.
Yeah, and international. Also seeing some inflows or not, VEA, right?
VEA is very popular, so that's the developed markets ETF, and then BNDX I was mentioning before, so international fixed income investment grade. Despite the talk around low or no yields for international bonds, you're seeing more and more interest, less home bias amongst investors for fixed income.
But you guys have also launched a bunch of active products. Have those been getting the investor attention that you guys have hoped?
Yeah, so we launched a suite of factor ETFs, 6 factor ETFs last February. Slower uptake, naturally, I think, for us. Active requires a track record. We're about 18 months into their life cycle. It's a different concept, and so there's lots of education we're doing in terms of teaching investors how to invest with factors. It's not appropriate for all investors, but for some investors, they want to have very specific exposures.
I often hear about misperceptions about Vanguard. Somehow Vanguard is not in favor of active management. And I'm a Jack Bogle disciple from way back. I always point out Jack was never opposed to active management. Jack loved active management. Jack had Wellington, one of the great investment firms of all time, behind him. What he was against was high cost.
That's right.
And that the costs associated with the fees often destroyed the alpha that any active managers had. This makes perfect sense to me. Vanguard continues to have active management funds, some of which are very successful, although obviously if you're like Bogle concludes, it's really, really hard to outperform the market long term. An average investor is perfectly well served in staying in index funds.
Well, that's right. We have more than $1 trillion in active equity and fixed income mutual funds. The average expense ratio there is 20 basis points. We give those funds a fighting chance to outperform. That's no different from the factor funds we launched last year, which are all under 20 basis points.
John, where are you on the active versus passive these days? Encouraging your clients to do what?
We use a combination of both. So we're active management of passive ETFs or rules-based ETFs.
Yeah, you're a tactical investor.
Yeah, so we combine the best of both worlds, and I think that's really the
Can you do that? This is a good point here. Don't stop worrying about whether you're picking a guy to pick stocks. How about I'm picking your ETFs for you? Tactically, I'm moving in and out. That could be just as successful owning plain vanilla index funds if you're tactically moving around.
Well, I mean, anyone who's buying an ETF is effectively doing active management. Unless you're buying the total world ETF, VT, you're making a bet on the market you're tilting more towards large caps or small caps, and so every investor is doing some form of active management. It just runs a spectrum.
Yeah. I'm so glad you said that, because that's not really the message that's being kind of delivered.
Yeah. We're all active managers. They're just those of us in denial.
Yeah.
Let me ask you about the low costs. We keep bringing it up. The media gets very big on this. Oh, there's a new zero cost ETFs now, not 3 basis points. The VOO is 4 basis points. That's the S&P fund. SPY, your competitor, is 9, and they've been losing some. There's a core iShares IVV, S&P. That's about what you are. Does it matter at this point? I know it matters for big institutional funds, but would your message to the average investor is focus on something besides 3 basis points versus 4 basis points?
Well, I think there's more to it than just expense ratio when you get to these levels. When you're talking about 3 basis points versus 4 basis points, things like tracking error, tax efficiency, bid-ask spread, it matters a lot more versus if I'm comparing a 3 basis point fund versus a 30 basis point fund, I might be able to start and stop with the expense ratio comparison because that's going to guide whether a fund's successful or not.
Yeah, I like to point out, by the way, that Vanguard total stock market is probably the largest fund in the world if you include everything. Isn't it close to, how big is Vanguard total?
Oh gosh, it's got to be, when you add all the share prices together, probably $600 billion.
Yeah. I like to point that out to people. They don't quite get it. Before we let you go, how do you feel about this heavy concentration that I complain about all the time? You pointed out before in discussion, this has happened in the past. We've had intense concentration. In the 70s, oil stocks had stupidly high concentration. Does Vanguard worry at all about that? Do they give any advice to their investors? When
you're buying a large cap portfolio, you're naturally, because the market is voting in terms of the price of and the shares outstanding, what the weights of those securities should be. And so the current weight of the S&P in the top 10 is really no different than it was 10 years ago, 15, 20 years ago. The constituents are a little bit different. If you were concerned about that, then you would go to a much broader fund and buy a total world ETF where you're holding the entire U.S. world market cap, and that reduces your exposure to the top 10.
Or you can buy equal weighted, or even reverse, as you mentioned.
Yep, lots of ways to skin that cat.
I'm going to check this a little carefully. I certainly agree it wasn't that way all of there were times in the past where the concentration was this high, maybe higher, but 21% for top 10 seems pretty high to me. I'll check that. But thank you for joining us.